Where I think people are probably wrong on this is that you could easily see, and I think you will see, asset pricing and inflation continue higher, say first quarter next year. And then what does the Fed do? When inflation ticks back up, and now they're in this idea that, hey, we're going to lower. And I think the lowering has to do with they've got to finance these U.S. deficits and also the bonds that are, 15 trillion in bonds coming due next 3 years for our federal government. That's at a rate of about 2.3%. And if they had to put it out today, it'd be 5. So, it'd be a tremendous cost. So there's a lot of things working in here, and it's hard to see how they come out. But I do think it ends up being, and I've said this before, we've said this the last 2 years, that we felt like the next 10 years it's going to be like it was in the 70s and early 80s, which will be sort of a stagflation. I don't think the Fed will know how to operate in that environment, but we'll find out. Right now they look great. We're going to soft land it and everything will be fine. But real rates, if you subtract the inflation rate, from the interest rates, they're still too high. So what should happen is you'll just have to see this. You'll have to see if they follow that. But if they follow it down, then you have to remember inflation can rear its head again. And I think that's what will throw them the next 6 or 9 months. Well, I don't think anybody knows on recession. You could still have times when the economy doesn't do all that well. I think that people don't realize, again, that certain parts of the economy are in recession. It hasn't shown up in the stock market. I think what'll happen is stagflation bit, talking about the dollar and all that. I think the margins will fall. There's a lot of things that could come into play. And I'm sure people are going to say, we're not going in recession. They've got this thing handled. I don't think you know yet. I don't think you'll know that until you get into maybe 9 months, a year out, because think about it. You have an election coming. You have a change in government, no matter who wins. If you look at construction and residential real estate and industrial work, there's 7 or 8 areas where we're in basically a recession. I mean, if you want to look at the numbers that are coming in. And I think people think that because the stock market is where it is, that there's no recession in these categories. But if you go out and talk to the businesses in those categories, they will tell you that business is slower. It's definitely slower. And they've had to lay people off. And in the tech area, if you look at it, go out and find a tech job today is not easy to do. And I've talked to a number of people in the industry. I'm talking about people that place people, and so many people trying to get the same job now in the tech area. So we'll see how it pans out. But I think people look at the stock market and forget about what else is going on. And, like employment's the last that's the last thing that happens. Unemployment goes up, and we'll have to see if that's going to take place. One of the things I find right now is that people they're totally complacent. The market's up, the real estate's doing well. I mean, from where it was 4 years ago or 5 years ago. So it's like, hey, I'm rich. I think that's kind of the attitude that's out there right now. So until you have some breakage of that, probably going to feel the same way. Well, supply is going up. It was just in the San Antonio, Texas paper here 10 days ago that they have I believe, an 11-month supply, the highest it's been in many years. And you're starting to see that in a lot of cities. And then you're starting to see these hot cities that were so hot: Nashville, Florida, Austin, Phoenix, all those sorts of places. Kansas City, they're slowing down, and particularly at the high end. I mean, you're seeing markdowns in all of those properties. Now, the builders are still selling those $250,000 to $300,000 houses. They're really not much of a house. They're like a sort of a glorified hut because they're small. I mean, they're talking about, so they sell that to make people feel good that they're in a house. But I'm talking about a house that's 2,500 feet or higher. That market's not working right now. And realtors, so they'll tell you it's picked up a little bit. Most of the builders I know, even private builders, they're buying down the rates, so they're able to get these people in at 5 3/4 or something like that. But it's not a hot market right now. First of all, the dollar is falling, and I think it would continue to fall. So if you're in this stagflation mode and the dollar's falling, that means that everything we're buying is going to be higher, okay? And we import a lot of things. I'm not talking just at the consumer level, but I'm talking about at the manufacturing level, and you look at a lot of things that we bring in are going to go up in price because the dollar goes down. And those countries are not as worried about it because they keep on buying gold as the hedge. They're not as worried about the dollar now as they would have been. They used to be tied to it a lot. They're trying to get away from it. It's an interesting situation right now. The other side of that is you let commodity price relative to, say, the S&P 500, the S&P Commodity Index, it's all-time low. You don't have to have a lot right now. I mean, you can have things start to move up, and it'll be like the 70s. I know I was around then, but a lot of people don't realize that in the 70s, it threw everybody off because you couldn't buy long bonds. Commodities went up, the markets just stayed in a trading range, and that's sort of what it came out of that. Then you had gold go up, a lot of things happened, but I think that's what people are missing here. If the dollar keeps on sliding, your prices are going up. And then, I don't know this would happen, but it could happen if you keep having all of this thing going on war-wise in the Mideast, and if oil goes that much higher, let's say above 3% of GDP, 3.5%, then you're in trouble. That's what people forget to see in all of this. And they think, well, the Fed will take care of it. Well, there's a lot of things they can't take care of. That's why I think the inflation piece will come back in eventually. Maybe it doesn't this month or next month, but I think eventually it gets back. That's why we have a lot of things in that category. Every day I look at the 3-month and 6-month Treasury yield because we own a lot of floating rate U.S. Treasury, so we want to see what that rate would be. And it's about like I thought. When Fed funds go from 5.5 to 5, which they are, then you're going to have the 3 months trading around 4 3/4, which is still not a bad yield, by the way. And I think that's been the impact. You're dropping the lower rates. If you look at 3 months to 18 months, they're going down. But if you look at the long end, they've gone up. I think generally on the long end, what the marketplace is telling the Fed is, we really don't believe you on inflation. So we're not going to rally that long bond too much, maybe some. And for us, we don't have a lot of exposure to the long duration. We have some, but we picked that up about 2.5, 3 months ago, and it's done okay. But we watch it in here because you may not have a lot further to go with the long end, maybe not. But on the short end, what we've done in the last 4, 5, 6 months is we moved a lot of our 3-month paper to 12, 15, 18-month and 2-year paper. And the idea for us there was that no matter what the Fed does, if they lower the rates, that's good for that because we have a lock-in. If they don't lower the rates or we go the other way, then I just have to wait for those bonds to come due and I still don't get hurt. I don't know if that makes sense, but it does. In other words, we're trying to handle it so that from a risk management standpoint, we don't get hurt either way. I think if you buy gold, you have to think of gold like this. At any time you buy it, it could correct, 10 or 15%. But if you're buying it for the long haul, and I say, the next 3 or 4 years, you could buy it now. Yeah. Maybe you don't buy as much as you normally would, but you could certainly buy it. I think the investing public and even the pros are very, very uninvested in gold and gold miners. I know they've moved, but I think they're very underinvested. When they finally catch on, like a 2011, these prices and gold price too could be much, much higher than people are thinking right now. And maybe it's not, but if you look at gold over time, you have to think about it this way. If I own it, I'm going to own it for a long time because you will go through periods where you'll have 3 or 4 years where nothing happens. Maybe it goes down. But on the long run, you go back and look at the number one performing asset since January 1 of 2000 over the S&P and anything else, gold. People say, yeah, but I didn't make any money between 11 and 16. No, I understand. But you also didn't make any money in the S&P between 2000 and 2012. So which one do you want, And I'm not saying you put the whole portfolio on gold, but if you see the next 10 years under what we think will be, been saying this all along, it'll be different. And a lot of pros in my business don't know how to handle this, and they won't know how to trade. You're going to have to trade bonds. You're going to have to own commodities, some commodities, have to own some gold. And I think if you've got to have that in your portfolio, if you're going to have a good mix, and you can't just depend on these 7 or 8 stocks, because if we're in for that kind of period, gold will be fine. If you bought it here and it comes off a couple $100, I understand that. Don't sell it though. Because you look up the next 5 years and maybe it's 4,000. All these foreign governments that are buying gold, they do not want the dollar. And they keep on buying gold. Then they see this trade, for example, oil, gold, dollar. Okay. I think what they're trying to do is say, we want to get to a point where we can hedge all of that, and gold is what we're going to do it with. And that's going to be our new, maybe, world reserve. I'm talking about country by country now. You just see they keep on buying it. And the public, our public and investment managers, they're totally underweight gold and gold miners. They own very little of it. If these countries could snap their fingers tomorrow, these top 11 or 12 countries that really have been buying all the gold, they would love to have a currency that they could use that was backed by gold, that they could trade everything with. And they understand what's going on with the dollar, and they understand what the U.S. government is doing. I think that's why they look at the thing the way they do right now. I think what you have to do right now is decide, first of all, for you as a person, number one thing, how does volatility affect me? I mean, the average person, you have to think about that. And then I want to throw this in. Age has a lot to do with it. And I will tell you that a lot of people today over 65, and we see it all the time, even over 85, have way too much stock. They've done really well the last 10, 12 years. And I keep asking that question to them. Are you okay if for some reason a year or two from now you only have 60% of that or 70% of that? They can't answer that question because they can't even fathom that could happen. But if you're going to be the kind of investor that lives for every day and makes it through to the other side, no matter what, you're going to have a safety valve.